Tariffs are back in the headlines. Again. And if you're someone who depends on dividend income, or even just wondering if dividend stocks are the right move in this kind of market, you're not alone. One question keeps coming up. Are my dividends safe? Or even more often, is this the right time to start investing for income? Dividend stocks are often seen as the steady, boring backbone of a portfolio. You buy them for peace of mind, not drama. But lately, even the so-called safe stuff doesn't feel so safe anymore, especially when government policies start rattling global trade. So let's talk about it, calmly, and with some historical perspective. Because believe it or not, this has happened before. Back in 1930, the U.S. introduced the Smoot-Hawley Tariff Act, a well-intentioned move to protect American industries with higher import taxes. But what followed wasn't stability. It was retaliation, collapsing trade, and eventually the Great Depression. Other countries responded by slapping their own tariffs on U.S. goods. Global trade volumes fell by more than 50% within a few years. Export-driven companies collapsed, farm incomes dropped, and consumer prices soared. The whole world entered a cycle of protectionism and contraction. And dividend investors? They got crushed. As corporate profits dried up, companies slashed or suspended dividends altogether. Income streams people relied on disappeared. Now, I'm not saying we're headed for another depression, but I am saying when tariffs start flying, it's worth asking, what did we learn last time? And how can you protect your portfolio this time? Let's start with the ripple effect most people miss. Tariffs aren't just about foreign factories or trade headlines. They change the cost structure for everyone in the supply chain. Companies that rely on imported parts or raw materials, and that includes a surprising number of dividend payers, suddenly see their input costs go up. And when costs rise, companies have choices to make. Cut spending, raise prices, delay hiring, or in some cases, reduce their dividend payout. It's not usually immediate, but the effects are real. During the 2018 to 2019 tariff cycle, the average U.S. household paid an estimated $1,277 more per year due to increased prices. That cost wasn't just a consumer problem. It was a signal that companies across the board were dealing with tighter margins. And when margins shrink, so does the room to maintain reliable dividend payments. But over time, the pressure builds, and your dividend income, the thing that's supposed to be stable, starts to wobble. Let's talk about the stocks we think of as defensive. REITs, utilities, big brand consumer companies. These are favorites in dividend portfolios for a reason. They pay regularly. They're predictable. Often they operate in sectors people rely on. Housing, electricity, groceries, which makes them feel like a safe harbor. But predictability doesn't mean invincibility. These sectors are often rate sensitive, meaning when inflation ticks up or interest rates stay high, which tariffs can indirectly cause, their valuations get hit hard. Even Federal Reserve Chair Jerome Powell has acknowledged that tariffs can be inflationary. That matters because it gives the Fed a reason to keep interest rates elevated. And when rates stay high, dividend-paying sectors like REITs and utilities often struggle. Their borrowing costs rise, refinancing becomes more expensive, and investors may rotate out of these stocks in search of safer yield elsewhere. Utilities and REITs in particular tend to carry a lot of debt, so higher rates can squeeze their margins fast. And that pressure doesn't always stay on the balance sheet. It can affect dividend payouts too. Worse, many of these companies rely on global supply chains for equipment, maintenance, or raw materials. When those supply chains get disrupted, as they often do in tariff environments, operating costs rise, timelines stretch, and profitability shrinks. That's especially dangerous for businesses with already thin margins. We saw this dynamic back in 2018 when trade tensions flared. Investors fled high-yield sectors for safety. Prices dropped. Yields spiked. Not because of improving fundamentals, but because of growing uncertainty. So just because a dividend yield looks high doesn't mean it's healthy. Sometimes it's a red flag in disguise. That brings us to the question many investors are now asking: how can I tell which dividend stocks are truly reliable in this environment? If you're holding dividend stocks right now or thinking about getting in, here are a few quiet signals worth watching and why they matter. First, check the payout ratio. This tells you how much of a company's earnings are being used to pay dividends. If the payout ratio is already high, say over 80%, then any hit to profits, whether from rising input costs or softening demand, leaves very little room to maintain those payouts. For instance, during previous tariff waves, some industrial companies with stretched payout ratios had to freeze or cut dividends just to protect their cash flow. Second, look at import exposure. Is the business relying on overseas parts or materials that could get pricier overnight? This was especially visible in 2018 when tariffs on steel and aluminum sent shockwaves through manufacturing. Companies that couldn't pass costs on to customers saw margins tighten quickly, and that can eat into the capital typically reserved for dividends. And third, consider whether the company is selling discretionary goods. These are the want-to-have purchases, not the essentials. In inflationary environments, consumers tend to pull back on discretionary spending. That can hit revenues and earnings harder than expected. If you're holding dividend stocks in sectors like apparel, leisure, or luxury, make sure they have a strong balance sheet and flexibility in their payout policies. These signals won't guarantee results, but they help you assess where the real risks might be hiding in your portfolio. Being aware of them puts you in a stronger position, and that's the first step toward investing with confidence. Some investors assume that tariffs are good for domestic industries, that they'll trigger a manufacturing revival and bring jobs back home. And that could mean good news for dividend payers, right? Well, not so fast. During the last major tariff cycle, U.S. manufacturing employment didn't rebound. In fact, factory investments slowed. Why? Because when companies face uncertainty about costs, regulations, and global retaliation, they hold back. They delay expansion, and they become more conservative with capital, including how much they return to shareholders. So the idea that tariffs automatically strengthen dividend payers? It's more myth than fact. If anything, it reinforces the need to be selective and informed. The most resilient dividend stocks tend to share a few traits. They have low payout ratios, giving them breathing room. They operate in essential sectors, think utilities, certain telecoms, or healthcare providers. And they have domestic supply chains, which means fewer surprises from shifting trade policies. In other words, they're boring, but in the best possible way. The good news? Unlike in 1930, we now have historical perspective and tools that investors back then could only dream of. We have faster access to data, better diversification options, and decades of lessons baked into modern portfolio strategies. More importantly, we know that policy shocks, no matter how intense they feel in the moment, are often temporary. But companies with disciplined balance sheets and investors with a long-term view tend to endure. They don't just ride out the storm. They often come out stronger for it. So instead of asking, are dividends safe? Maybe the better question is, which dividends are built to survive? Tariffs can shake markets, but a thoughtful dividend strategy doesn't just survive, it adapts. And staying calm when others are panicking? That's one of the most powerful investing tools you have. If this helped clarify a few things, give it a like or share it with someone who needs a little less noise and a little more calm. And if you're ready to keep building peace into your portfolio, check out my video about how to survive volatility. It's where I break down exactly how to protect your portfolio, the strategies you can use right now to reduce stress, stay invested, and make decisions with clarity even when the headlines get loud.